Have we seen the bottom of the market? What is going on in these markets? It's a very common question I get. In fact, one of our subscribers today on our software said to me, Paul, what are you doing? The bear market's over. The bull is starting. I don't think they were joking about that. So again, let me explain to you my views on where I look at stocks. So first off, if anybody ever says where stocks are going to go in the next 3 months, year, even 2 years, it's too difficult to figure it out. No one has a clue. What we can do is we can use reliable long-term metrics to determine if stocks are overpriced or underpriced, and that can help guide where stocks may go over the next 10 or 15 years. Now, you might sit there and say, oh my God, Paul, it's so boring. Guys, this is what every successful value investor in history has done. They care about putting money to use today based on a long-term perspective. Now, with that said, 4 or 5 years ago, the S&P 500 cyclically adjusted 10-year PE ratio. I know that's a long thing to hear. Cyclically adjusted 10-year PE. What that does is it takes the last 10 years of the S&P profit, brings it all up to today using inflation, and divides the market cap by that. Historically, it's around 15 or 16. It's currently at 30 today. Historically, it's 15 to 16. That says double. Now, what does that mean? Well, during the dot-com boom, it hit 44. But 4 or 5 years ago, when I said the market was overpriced, it was at 25. And you might sit there and say, Paul, that's so low compared to, we even got as high as 38 recently. And you're right, it is low. But apart from the dot-com bubble, going back 150 years, that was the highest it had been without a crash. So I was like, okay, I'm assuming we're not going to have another dot-com bubble. Boy, was I wrong. Now, fast forward, we went through COVID, market soared. I do believe today the market is more expensive than it was during the dot-com bubble. There are 3 metrics I look at. The first one was that 10-year cyclically adjusted PE ratio. The second one is the stock market to GDP ratio. This is the one that Warren Buffett calls the single most accurate metric at any given time on stock market valuations. Historically, it should be 70, 80%. It takes the full stock market, US GDP market cap, divides it by US GDP. We want it between 70 and 80% for normalized. It is currently about 150 to 160%. So again, just like the 10-year PE, this is about double the historical average. The last one, which I don't use as much, but I have used, is the price to sales ratio. It takes the market cap of all the stocks and divides it by the sales of all stocks. Historically, it's around 1. Currently, it's about 2.2 to 2.4. I haven't checked it in a few weeks, and the market's gone up a lot. So it might be 2.4 or so. Guys, this is high. This is very, very high. All 3 of these reliable metrics, if you go back in history and you look at how they chart the next 10, 12 years afterwards, they're all very good indicators of how stocks will go. We need stocks essentially to fall in half. Now, there could be a combination of fundamentals getting better and stocks falling. That's absolutely part of it. When will that collapse occur? I have no idea. Would anybody guess in June that the S&P would go up 9.1% in July? Of course not. That's just too hard to figure out. We have no idea. So if you're new to this channel, you might be asking, well, then what do you know, Paul? Well, what I know is I remove my emotions out of my investing decisions. I pick good fundamental companies that I can buy at reasonable levels. And if they fall and my assumptions are still the same, I buy more of those shares. The same thing for you. This is what I want you to do. This is the stock market's value over time. This is what the market will do. And if you've watched my videos before, I do this all the time. Your job is to dollar cost average all along the way. And the reason being, sometimes you'll overpay, sometimes you'll underpay, but over long periods of time, you will match the market. So what does the market do? 9 to 10% a year. Now here's the scary part. For those of you who don't do dollar cost averaging, you're going to claim you're different, but you'll end up buying here and selling here. And instead of getting 9 to 10%, the average investor usually gets 2 to 4% a year because they buy at the wrong times and they sell at the wrong times. And if you don't know how big of a difference 5 to 7%, 5 to 8% makes per year in your returns, join our software. Our software has a retirement calculator. Over a 30 or 40 year period, 5 to 7% a year can literally be the difference between retiring as a multi-millionaire or retiring and barely having enough money to live the rest of your life. That's how serious it is. So the hardest part about investing is the emotional aspect and getting rid of the news. Everybody out there wants to know, are we in a recession? I don't know. Where's the stock market going to go? I have no idea. I'm okay sitting on the sidelines and waiting. I am okay doing that. For the average investor out there, you need a dollar cost average. If you want to sit with some cash on the sideline to buy individual companies that you love at better prices, I love it. Go do it. In our software, everybody in this community, thousands and thousands of active people in this community, sit there and talk about investing all day long. They use our software, including our stock analyzer tool, to analyze stocks that they love to figure out what price to buy them at based on their assumptions. And as stocks go down, as long as their thesis is the same, they're going to keep buying more of that stock. That's what I do month in and month out. I wait for stocks to get the points where I like them. And some stocks surprise to the upside and some stocks surprise to the low side. Just remember, think back in history. Go look at every recession and every stock market crash. Fast forward 10 or 15 years later, and the people who are the richest are the ones that invested during those tough times. So instead of worrying about what's going to happen next, worry about what you can do today. If it means sitting on the sideline, sit on the sideline. But make sure you dollar cost average into low cost ETFs, because you'll never, ever, ever be able to get the top or the bottom of the market. When is the market going to bottom? I have no idea. Neither does anyone else. Anybody who says otherwise, you need to run away because they are selling you snake oil. It is literally impossible to pick the bottom and the top consistently year in, year out. If you think otherwise, Warren Buffett would never, ever do that. Charlie Munger would never, ever do that. Seth Klarman would never do that. My friend Gary Mashuris would never do that. Nobody in this world can ever predict that. Your job, I'm going to repeat it till I'm blue in the face, dollar cost average. Now, if you've seen our videos before, you're like, Paul, you say the same things over and over. Exactly. Money is the same decade in and decade out. You're looking to buy as much cash flow as you can for as little as you can. But here's what's happened. You're buying a little cash flow for a lot of money, or you're buying a lot of cash flow for even more money. That just in and of itself leads to lower returns. The more you pay for something, the less your returns are going to be. The less you pay for something, the more your returns are going to be. And don't get me wrong, there's always stories behind every stock going up and every stock going down. But remember, we live in an age of information now, where information comes out like that. A company releases its earnings, and I'm literally hitting refresh, waiting for their earnings press release that happens within seconds. We know how the company did. That is going to affect people day in and day out. That's why the emotional part of investing is the hardest part of investing. It's not the numbers. It's being in a company or being in the stock market when it feels like it's going to zero, and taking the noise out and saying, is it really going to zero? Because remember, to be the best investor, you got to do one of two things. You either got to do the exact opposite of everybody, or dollar cost average and low cost ETFs, which, by the way, is the exact opposite of everybody. Because everybody says they're going to do that, and they don't actually do it. So be wise, join the community, be around like-minded investors who are going to look at the future and realize that you'd rather be right 10 years from now than right today. Thank you very much. Please subscribe to our channel and follow me on Instagram.